Hi everybody, Thomas at Rebel Income here. If you haven't already finalized your Christmas shopping, you're going to be like me and millions of other Americans, scrambling to find the right gifts for your loved ones in the final days leading up to Christmas Day. That's just one reason retail stores like Best Buy are of interest. The entire holiday sales period is typically a high watermark for specialty retail businesses, and Best Buy is no different. The stock is significantly below its all-time high, set in January of 2022 at around $136 per share. Does that mean it could be offering a useful value right now, just in time for the holiday? Or is it just another sucker's bet? Let's dive in and find out. For the past month or so, the stock has actually been rallying pretty strongly from a low at around $62 in mid-November all the way up to its recent peak at around $75 just a few days ago. The stock has been retracing back down from that point, but is starting to approach expected support around the 20-day moving average, which is sitting right at around $71 right now. The 200-day moving average is also right near that peak at around $75, which means that's the immediate resistance point for this stock right now. The question for value hunters and fundamentally minded investors, however, is whether or not the company's overall book of business is strong enough to suggest that it's a good value at this current price. Let's go ahead and take a look. Best Buy's free cash flow numbers for the past year are a picture of dichotomy. And by that I mean that over the last 12 months, free cash flow has increased from about $894 million to its current level at just a little bit below $1.4 billion. Now, that's a positive trend. However, if we look at the 2 quarters in the intervening period, we can see that free cash flow has also declined significantly from almost $1.96 billion to that current level, a little bit below $1.4 billion. So we have a generally declining pattern over the more recent quarters in free cash flow. That same pattern is also confirmed by a decline in cash and overall liquidity. We can see that a year ago, cash was at about $1.8 billion and has since declined to about $636 million in the last quarter. That includes a decline of $800 million 3 quarters ago and about $400 million just in the last quarter. That's an erosion of liquidity that gives the company less financial flexibility to invest in its business, to seek out acquisitions, and to find opportunities to return value to their shareholders. Long-term debt is a point of strength. In fact, it has remained relatively consistent, but has also declined in each of the last 4 quarters from $1.16 billion to its current level at about $1.13 billion. Company has been servicing its debt without taking on additional debt. Like a lot of specialty retail stocks, Best Buy operates with generally narrow profit margins. We can see that reflected in its net income metrics. Over the last 12 months, net income was 2.93% of revenues and declined in the last quarter to 2.7% of revenues. Now, they are still profitable, and I consider that a positive, especially at a time when a lot of other companies, also in the specialty retail industry and in other industries, are seeing drops into negative profitability. Best Buy also offers a very interesting dividend right now of $3.68 per share, which at the stock's current price translates to a yield of about 5.08%. Also working in its favor is the fact that the stock offers an interesting value proposition. With a fair value target just a little bit shy of $90 per share from its current price at about $72 per share, that means that the stock is undervalued by about 23.5%. Now that's very interesting and looks like it could offer an interesting value proposition for a patient investor. The next question, of course, is where does the stock sit in terms of risk to reward? If you were to take on a new position right now, relative to the overall upside that you believe there is in the near or long term, what is the potential downside? Let's go ahead and dive in and take a look at that. With immediate resistance for the stock just a few dollars away from its current price at $75 per share, that means that there's about $3 of upside in the very near term from the stock's current price. The question is, if it breaks above 75, where would the next likely level of resistance be? There are a lot of schools of thought in how you can try to identify those. My preference is just simply to look for previous pivot activity above the stock's current price. You can see a fair amount of that going on earlier this year that we can trace back and is occurring in the $78 range, meaning that while the stock has about $3 of near-term upside if it were to bounce off of current support right now, it's got about $6 of longer-term upside if it could push above that $75 mark. With current support at around $71 and the stock just a little bit above 72, that means that right now, in terms of near-term upside, short-term reward to risk is about $3 of up compared to about $1 of down. That's pretty interesting from a short-term trading standpoint, simply because we have a 3-to-1 reward to risk ratio. What about in the longer term? If the stock does break down and drops below the 20-day moving average at about $71, how much further down could it go? Again, the idea here is to look for previous pivots that are below the stock's current price, below that current support level. We have a significant pivot low in May that coincides with a lot of pivot activity in September and October, and seems to line up at about $68 per share, which is about $3 below that current support level. That also puts our longer term reward to risk ratio at about $6 of upside compared to $4 of downside, which is a little under our 2-to-1 preferred level. When you consider some of the current drawdowns in free cash flow, in liquidity, in the generally moderating profit margins that we're seeing from the company's net income metrics, I think that the longer term reward to risk ratio is reflective of the fact that while the stock looks like an interesting value, it's probably not the best time to go ahead and try to look for that trade. I would look to see if the stock does actually stabilize around 71 and could possibly push a little higher, and more particularly see if those fundamental metrics can strengthen in the quarters ahead. Until then, Best Buy right now looks more like a sucker's bet. Thanks everybody. I hope you found this to be useful as always. If you like this video, please go ahead and subscribe to my channel by clicking on the link shown right here. You can also learn more about my Rebel Income investing system by checking out this video here. If you'd like to subscribe to my trading alerts and reports, you can do that on my Patreon page. You'll find the link to that page in the description area of this video. Thanks again. This is Thomas Moore at Rebel Income. Talk to you again soon.